If you want to win at trading, you need a system that works for you around your lifestyle, your commitments, and your preferences in a way that can be systemized into a process that consistently prints positive results for yourself. That style of trading should be dynamic narrative trading. Now, this sounds like some fancy buzzwords, but I'm going to break down what this is today. Starting with dynamic, this basically means it can be applied to any asset, any time frame, any time of day, and any trading style without actually breaking the systematic nature of this system. Narrative means we are deriving our opportunities from the story the market is telling us, instead of following arbitrary patterns, indicators, and cookie-cutter strategies. When we finish this class, you will have a systemized process that you can easily apply every week that gives you maximum conviction behind the trades that you take, and that can be adapted to day trading, swing trading, any session, any asset, however you personally want to trade, because that is an important element of sticking with the system long term. Now, what I'm about to show you in this video took me years to work out and tens of thousands in losses, but now that I've cracked it, I don't see why anyone would want to trade in any other way. So what is this all about? Well, we're going to start with exactly how I found this out and how I worked this out, and it was actually through a book called The Market Wizards. This is basically interviews with some of the greatest traders, investors in history. I've been losing a lot of money in the markets, and I found this book and I hoped it would give me a strategy or something I could do where I could copy what they're doing and actually then start making money. Well, I didn't really get that, but what I did get was something very simple and very effective, and it actually changed the way that I saw the markets entirely. See, all of these different traders that were interviewed that had made significant sums of money, some of them billions of dollars, were trading different assets, different markets, different timeframes, and different levels of capital, and they were operating with different personalities and preferences. But they all had the same foundation in place, and that was all of them operated a repeatable, rules-based system, and you need one of these. So if we think about how money is made in trading, it is simply made by repeating plus EV, positive expected actions, right? Which basically means if you have a system with a 1 to 2 risk reward ratio or more, meaning you're risking $1 to make $2 on winning trades, you win around 50% of the time. So you're essentially flipping a coin and winning more on the winners. This is your edge, right? When you have this edge, you apply it over and over and over again. So you find out what it is that will allow you to take these trades with these outcomes, and then you just do that and you do nothing else. And over time, that will lead you into the positive. And you can't choose your exact performance results, but if you follow the plus EV action system, you will turn out with returns in the end, okay? Now, if you don't have an edge, everything is left up to luck, and you can win for some period of time through pure luck, but you're basically gambling your entire future on this, and it's not going to work for long. Eventually, things will fall apart if you don't have an edge in these markets. So if you want to achieve the plus EV, the positive outcome, you need a way to consistently repeat those plus EV actions that make the winning trends happen. And that is why we systemize, so that we can do the same thing over and over again that we know long-term will give us a positive result. So to do this, we are going to build out a rules-based system. We want everything to be systemized into a start-to-finish flow. We analyze the market, we see if a setup is present. If it isn't, we don't trade. And if it is, we check the next thing, that is entry criteria. If that's not met, we don't trade. But if it is, we check additional considerations, anything else that may influence the trade. If that's not met, we don't trade. But if it is, then we take a position. This automatically filters all of our trades so that we only take the best of the best. This means we have the highest win rates, the highest possibility of actually getting to a successful trade outcome, and the highest rewards on the trades that we do take. It will shift your trading into a simple daily process, which has no room for guesswork, and results in calm, confident trading that actually gives you results, okay? So let's dive into narrative trading first of all. So I said with narrative trading, we are actually deriving our opportunities by reading the story the market tells us. This is way better than, for example, arbitrary systems like support and resistance, where the idea is you should buy a support floor once the market has traded over it. Now, this can make you some money, but the big problem with this is that you don't really know why this is happening. Why exactly should this invisible line that you've drawn on the chart actually give you a winning trade? What does it even mean that this has taken place? Likewise with the cookie cutter systems, the systems that tell you just do this at 9 a.m. Why though? What is it exactly that's telling us that this is going to lead into a winning trade? Now, when we don't have confidence behind the system we trade because it doesn't really make sense to us, or we don't really understand the mechanics of why the market is doing this, we can't really trade this with confidence, meaning we'll be stressed, anxious, and hesitant in every trade you take. And when you feel that way, you skip trades, you close trades early, and you make bad decisions which overall destroy your edge. See, a standard trading system, when performed well, should realistically look something like this, right? We don't have a linear drive up in trading We're going to have losing trades, we're going to have winning trades. And your performance may look like this. You take a few losing trades, then you take a nice big win, take a couple more losing trades, and you take a nice big win. When you understand your system, this is easy to do. But when you don't fully trust or understand the reason why you're taking the trades, what you can often do instead is take a few losses and then hesitate because you're on a losing streak and you don't trust the system. You see a setup, but you think this one's just going to lose, so I'm not going to take it. So you miss the win, and then you take more losses. You hesitate out the next win, and you take more losses. And before you know it, everything you've worked for up to this point is completely gone. You failed your funding challenge, you've lost all of your account, nothing is working out, and you're just digging yourself into a hole because you're just too worried to take the trades that can actually make the system perform well long term. So what we need to do is break you out of your beginner mentality of trading a basic checklist strategy that you don't really understand, following it blindly and then stressing every time you're in a trade, and move you into a pro trader mentality where you can read markets deeper and clearer than you've ever seen them before, and then confidently systemize that into a process that allows you to execute calm, consistent, winning trades, okay? The narrative part of this system is all about reading the market story so that when a trade goes against us, instead of thinking, what do I do now? We are left understanding exactly what the market has just told us to do. And now we think, okay, yes, that trade lost, but this has opened a new opportunity because I fully understand what the market is telling me from the ups and the downs, the wins and the losses that it's actually creating for me. So what you need to do first of all to trade calm, confident and successful long term is build that level of market understanding. So let's start with a question. When you open a chart, what is it that you're actually looking at? Now, a lot of people will say they're looking at price, candles, levels and patterns. And sure, these things are present on the charts, but they're not really what the market is all about. See, when I look at a market, I am always weighing the seller and buyer control. So markets go up and down because of willing buyers and willing sellers. If a market is moving down, this means there are more people here trying to sell this market than there are people willing to buy. So the sellers have to drop the price to entice the buyers to actually take up the other side of their position, right? It's like a big auction. Then, if we start to see the sellers weaken and we see the buying coming back in, this simply means that buyers have found interest in this market and they are buying. And those sellers can now say, I'll sell you the asset, but I'm selling it you for a higher price. This is what drives the market to the upside. Now, when we see things like this, where the market breaks out of a high, but then it reverses immediately with pretty strong selling pressure, this is actually an absorption point where the buying has been totally taken over by the selling. So when the market reaches this high level, buyers are exiting en masse and sellers are entering en masse, right? These can be short sellers who are looking to profit from a downward move. And then when this leads into a seller-dominated market, I can see all of this happening before it takes place. And now I can even use this as more information to take continued trades, because what I'm doing is I'm reading that battle between buying and selling. I know who is in control of the market, and I know where the core points are that the market is likely to reverse or continue with strength. Okay, so all you are looking at when you see a downward moving market is that there is a volume of selling larger than the volume of buying. And now let me explain this just real quick, because this confuses people. Obviously, to take a trade, there has to be a buyer and a seller on either side of the position. You can't buy if there's no one to sell to you. So it's not that the volume of buyers is larger than the volume of sellers in a market that's moving up. What it is a volume of buyers willing to pay higher prices, okay? So if a seller in this seller-dominated market wants to sell their asset, but the buyers are not willing to pay this higher price, then there are less willing buyers than there are willing sellers. The sellers therefore have to drop the price to actually match a price that buyers will be happy to pay. Okay, that is how it works. So it's about a volume of willing sellers in this market is larger than a volume of willing buyers at these specific prices. And as prices do decline, then we will have more willing buyers stepping in. And that is why after large downward moves, we see these larger reversals, because people say, okay, this price is pretty good now, I think I will buy. And then sellers stop wanting to sell, or there's less sellers left to sell. So they will start saying, I'll sell at you, but I'm selling at you for a higher price, right? That is the kind of auction theory that the market runs off. That is what you need to understand to really read these markets deep. So when it comes to narrative, a narrative is a structured reading of what the chart is telling you, who is currently in control, what would confirm that, and what would change that. When you trade in a narrative-based way, you actually create an opportunity, and then multiple other opportunities can stem off of that opportunity. So rather than marrying one bias and saying, this is my trade, this will work, you basically build a picture as to what the market looks like it can potentially do. You work out who's in control, which way the market's going, and where those points of interest are, and then you stem multiple opportunities out of one narrative, which is what makes it so powerful. So really quick now, let's jump to the chart, and I'll show you kind of how we read this story between buying and selling in a market. Okay, so how this narrative trading works then is what we're doing when we're looking at charts is we're trying to determine overall who's in control of the market and where is that story likely to lead us. So if we look at this USD JPY weekly chart, we can determine just by looking at this weekly that the most recent move we've had is an aggressive impulse to the upside from this low. We then had a stall out so far, pullback, but no break of any meaningful lows here. And now we're driving back up with strong momentum again. So if we consider basically the battle between buying and selling, we can see that every time we've reached this level, we've seen aggressive attacks from buyers. Now, this second one wasn't as strong as the initial one. However, this third drive we've had is actually pushing us through these highs towards basically the open area, which would target this next high. So if we think about what that is actually telling us and what this is behind the scenes of just patterns in the market, we basically see buying has been incredibly strong on the US dollar versus the Japanese yen. Okay, for whatever reason, there are macro reasons for this, but we're going to keep it technical focused for here. And every time we've attempted to come lower again, even after this aggressive sell-off, we've continually pushed back up. Now, what this is basically buying is willingly taking place at higher prices consistently throughout this upward move. Then, for whatever reason, we had this dramatic selling move. However, the failure to get back under this low, and considering this is an uptrend overall, right? The failure to get back through the low here shows that buying is still stronger than selling in this market. Because if selling was indeed strong enough, we would have seen the market push through the lows that have previously been set as a floor by the buyers, right? We would have seen less people willing to buy at these prices, selling continue, all of these buyers that bought previously selling in, short sellers selling in, and basically we would have seen that close lower and then likely lead into further downward prices. However, what we've actually seen is every time we've reached this level, this has been a kind of floor that buyers have set in place. And this price range around 140 is essentially a price point that buyers are very happy to snap up massive amounts of these contracts at. So every time we reach 140, we see a massive new influx of buying and buyers willing to buy at higher prices back in towards the highs of the range, right? So from a buying selling perspective, we are basically told by the presence of this low that we've just mapped in around 140, that buying is very happy to take place above the 140 level, and buyers and general market participants basically see 140 as a viable floor for this market that really the market shouldn't trade beneath. So that's step one. Now the next thing is, of course, momentum. We can see these upward movements are very strong. Now this initial selling movement is very weak, but that is supported by what we just explained as that psychological 140 floor, price floor, that people don't want to see the market go through there, because every time we get there, we snap up buys. Now, this impulse to the upside is very strong. How do we know that? Well, the size of the candles and the speed that we completed this movement in, okay? When we had the pull back, if we take a look at the candles on the downside, these are smaller bearish candles than the ones that drove us up. We also see from the wicks that we're continually attempting to go back higher throughout the downward move. And here, where we have this kind of chop, this is basically buyers pushing back. So we still see, even in the downward move, that we have willing buyers coming in. Now, when we reach the low, what does this tell us? Well, the fact that we closed higher here than we did previously shows that there is more buying pressure and buying intent coming in at this point than there was here and that there was here. And this wick tells us that this is, again, that solid floor. Every time we get lower, the market is driven higher by significant buying. If we then lead into the buying move, sure, it started out weak. However, we pretty rapidly progressed in this move. And this quick movement and basically the failure to get any lower from the sellers indicates to us that buying is alive and well in this market. And that is what's leading us into where we are now. So if we take a look at the current position of price, this has actually taken out a previous high, only with a wick at the moment. However, just in taking out this high, so with this price move here, this indicates that buying now is stronger than buying was in the previous attempt to go higher. So we've actually driven through a high, which shows more willingness from buyers to buy at higher prices than previously. Then take it to where we are right now. We had a pullback, which was a pretty dramatic one. However, even more interestingly, is over the past 3 weeks into this analysis, this bearish candle has been completely taken out with this slow progressive bullish price action, which This progressive price action has no bearish pullbacks in it, right? It's one clean drive from there to where we are right now. Again, with this breaking through the high, indicating buyers here were willing to take it higher than previously, we're getting a sign of strength again. So it's all about reading the story of what the buyers and sellers are telling us in the print of the candles, okay? So if I were to look at this market, I would presume the most likely outcome will be a continuation on the buy side towards the high, because we're moving in an already bullish manner, and we are showing that the buyers are continually basically outpacing the sellers. We have buying setting a very clean floor, very aggressive rejections when we get to that floor again, and then clean buying taking place right now, breaking us through previous highs, showing more willing buying taking place at higher levels. So if we take a look at this on the daily, we can see, again, very similar kind of movement, right? We have this strong upward move. It's a little bit slow, but this is that weekly movement that was going on for a very long time. Then we have a very aggressive sell-off, which generally this will be a bearish sign and will tell us that sellers are stepping into this market in massive force. However, as soon as we had that selling move, we printed our low around 151. Then the market had a very aggressive drive back up. And when we attempted to go lower again, we actually failed. We closed higher. The wick didn't even push through the low, which indicates that sellers here are not as strong or willing as sellers were here. So when we see this aggressive price action again, which once again drives us through a high, showing more willing buyers at higher prices, this is an indication that this market is likely to continue trading bullish. So how do we turn this into opportunities? Well, if we think this market's going to keep going up, we can look at the high near term, and then what we can do is just map out the potential areas for this market to actually buy from. Now, I would look at these points initially, and we can go down lower to say the 4-hour time frame to really refine an idea. Okay, so we have now basically in mind that the market is indeed bullish, and we're being told that by the market participants themselves, by the way the candles are printed, right? This was our very low point after a dramatic sell-off. We managed to pull back a significant way, and then what would have proved us bearish, which would have been a closure under this low, failed. We created a higher low. Now, in terms of structure, not entirely valid higher low, but in terms of the actual market participation, a low higher than the previous one, indicating that sellers are weak, buyers are strong, and then we drive up through the high, further backing that idea. So if we zoom in the 4-hour perspective, that's just going to be a simple trend like this, and what we can look to do is just join this movement up, right? So from a trend perspective here, we would look at the highs and the lows that have been printed. We have a high, and then this high breaks through at this point to print a new high. Our pullback on this movement is around this low, this low. That's going to be our low. The fact that the low here is higher than the low here, again, tells us that buyers are trending to the upside over sellers, which means more buying pressure than selling pressure. And then in theory, the market shouldn't, if it does remain strong, shouldn't go under this level. So it should basically remain above this low, which what would that do? That would validate buying strength, because that would say, okay, the buyers clearly have a basically root of control here. And if they hold that, buying above this level makes absolute sense. And if we get under that level, then that could be sign of shift into seller control, which could mean we trade lower, right? So what we're doing is we're not just looking at patterns, we're reading what are the market participants telling us through the candles. Now, a trade that I took was simply this area of demand here. We had what I classify as like equal low liquidity. So basically what looks like a support floor in the market. We know there's going to be lots of orders under here. Again, this drives back to that market psychology. So if you've been buying at this level or at this level and you're a basic retail trader, you're going to have stop losses under the low. Now, because there's lots of stop losses under the low, there is a significant amount of orders here that the market can take the other side of essentially. So if we're able to drive into that big collection of orders towards this kind of core point, this demand zone, we know there's going to be lots of buy orders waiting here. If we think about what the stop losses are for buy trades, they are sell trades, okay? So we get lots of sells triggered here. They can be absorbed into buys, and then even more buying pressure in the form of this demand. Basically, these being prime points for massive buying absorption to take place. Pair that up with the fact we've already built our bias narrative to be bullish, and we can see this as a very simple trade to be taken, okay? So now, if we run that forward, you can see that is exactly what happens and how the market plays out. It came back down, traded into this zone, and then ended up rallying to the upside. And again, another trade I took, and I'll post these up in just a moment, was actually from this demand. So you see the same exact pattern occurred. We created a demand zone, which had some slight imbalances into it, 1, 2, so equal low liquidity. We came back down, traded into that area where buyers typically absorb orders, and then continued moving. And we did this because we built that big picture context, all right? Now, for some traders, they may see this shift here as a break of structure and start looking to sell the market. But if you've got the big picture context, if you understand who's in control of this market, selling there makes no sense. And you should be following the buy side ideas that I've just explained to you. And that's pretty much how I find them, right? It's contextual narrative building around the market. It's reading into the speed and the size of candles, but not just in isolation, but in terms of the larger movements and the pullbacks we see, the highs and the lows holding. All of this gives us information as to who is in control of the market. A movement like this, very strong upside, slow choppy downside, very strong upside, slow choppy downside. This tells us weak selling pressure in these points and strong buying pressure in the impulsive moves. When that is taking place, we know buying is taking place more willingly in large volumes than selling is. So therefore, we should look to join the buyers and continue until they lose control of the market. Okay, so that is a general overview of how we do this narrative-based trading and how I read markets myself. Contextual, it's top down, and it's all about reading the story of the market. And as you can see, those two trades followed through. Over that 1 week of price action, you get a couple trades there, which runs you higher into the targets and further validates that bull idea. Cool, so that's it. We're going to draw back to this in full detail in a moment, but let's jump back to the slides for a moment. So to trade with confidence, we want to answer 4 questions from our analysis. Number 1, who is currently in control of the market? Number 2, what confirms this expectation? Number 3, what would invalidate this idea? And then number 4, where do the trades come from as a result of all of this? Now, the problem most traders have is they skip all 3 of the first steps and they immediately just look for where are the trades, okay? You jump to the markets and you're just fishing for any opportunity you can find without building bias or context or an understanding of what it is that the market is doing right now. So you need to build bias before you execute. Now, if you've ever been on a low time frame chart, and you probably do this quite frequently, like the 5 minute, the 15 minute, or really any chart actually without bigger picture context, you might be left completely confused. You look for any opportunity for supply zones, demand zones, whatever it is you trade, you buy and sell them all, none of it works, and you lose loads of money at the end of the day or week. The reason for this is that charts at these timeframes, or realistically any chart without a big picture context behind it, they lack major context, right? You're not seeing the big picture, you're not seeing what's actually going on, you're seeing short-term speculative moves, you're trying to trade that, and that is where you get whipsawed around and killed back and forth on buy trades and sell trades. Now, when you bring in a big picture context and you read the narrative in the way that we've just explained there, you know what to ignore and you know where the real selling and buying points will be. So you can stop focusing on short-term tiny movements. So you can stop focusing on tiny insignificant moves and you can start focusing on the real buying and selling points in the market, fully understanding where those points are. So the shift that you need to make, the shift that I've made and thousands of my students have made, which actually got them profitable, is to stop looking for a trade. What you're doing is you're looking for the narrative and then you wait for the market to say go. The market will tell you when to take positions, okay? So instead of trying to predict the market and fish for trades, we just want to map out the possible outcomes based on the bias and context we build, and then build predefined scenarios for how we will approach each outcome, right? That if this, then that format that we discussed in the last class. So if I was to see this market, and we have some open imbalance and a demand zone below, but we can see at the moment that sellers are clearly in control of this market, I would say if the market returns, there's only really 2 things that can happen. The market can pull back and then sell down towards that level, or the market can trade up and break through that level. Now, it could also go straight to the target and that would just mean there's no trade, but these are the 2 predefined scenarios that would actually give us an opportunity, right? Then what we would do is simply say, if the market reverses inside of this range and confirms short, I will then sell down towards the target I've got. And if that fails and the market trades above, then we can look for reaccumulation and buy through the larger imbalance to the upside to the next supply, where maybe the market will sell from just then. So we're actually prepped on both sides of the market. And what we're doing is executing predefined scenarios instead of reacting to any tiny candle that happens in real time. We're just executing decisions that we've already made. Now, the powerful thing about this is when you move over to the markets and you're staring at a chart and you're trying to fish your ideas out, instead of thinking, what should I do right now? What we're doing instead is thinking, what are the only things that can happen? And what is my plan for each of those things, okay? It means you can hit the market both sides, and you don't have to stress or guess at trades. You just follow that if this, then that flow. And if not, if it doesn't validate, then you don't take any action. This is how you can catch the market both ways instead of being married to a bias through multiple losses when things don't go your way. All right, what we're going to do now is go through a trade that I took in March on GBP USD. And what I want you to do is kind of detach your mentality from the way that we'd usually view charts, where you're looking at patterns and trying to kind of formulate ideas without thinking about context, and listen to how I explain the way that I see charts and what it is that I'm actually looking at, okay? Because this will be a big step in your understanding of the markets and therefore your systems and performance. So we're going to start on the weekly. I always start top down with my personal trading, because if I'm on the weekly time frame, I can get a general broad idea as to where the market is, what the directional bias is telling me, and likely a range that we could trade within, okay? So by taking a look at this weekly time frame, we see this is obviously quite an impulsive bullish market up to this point. This tells us buyers were cleanly in control. When we reached this point here, we started to see that buyer control soften. We had sellers coming in, and we've kind of failed and struggled to get back up again in terms of significant buying. Now, one of the most significant things here is, if we take a look at this high, we had an impulse up to this point, and then in this week, a significant reversal from sellers, which drove us all the way back down here. Now, this is a really strong potential reversal sign, because if we think about what this is telling us behind the candles, right? We saw that buyer strength softened at this level and has basically pushed the market into this range. But this rejection shows, again, very clear control from sellers coming in when we kind of reach that we could call it a price ceiling that has been set by sellers. So buyers are just not so happy to willingly buy massive quantities up here. And sellers, of course, are very happy to sell, because this is a premium price. So if you're selling or offloading contracts that you bought, this is the most profitable point to do that. So you sell it when it gets back through the highs. If you're short selling the market to profit from a decline, this is obviously a very profitable point to do that too, because we're so high up that now, if the market does reverse lower, you're getting a significantly better entry up here to profit from the decline than you would be if you sold anywhere in around these levels. So this is basically a core point for sellers to start entering the market in force. And we see that because after the big rejection, we see continued seller domination. So when buyers see this rejection, they are now no longer too happy to start buying in numbers. Buyers want clean, impulsive moves like these, right? If we see a rejection like this coming from a high, this can easily be a point where the market starts to reverse. So we saw buying soften and selling kind of strengthen up in and around this range. And then that was somewhat confirmed as we pushed through the high and then reversed immediately into a phase of seller domination. Now I want to draw your attention to this low. So this point just here. Now this is not a massive important structural low, but it is an internal low within this leg of price. And if we consider what the break of this, which is taking place now, is telling us, it's basically telling us that buying, okay, here is weaker than buying was here, because buying was strong enough to drive us to an impulsive high, and it wasn't strong enough right now to actually hold the low that was created by that impulse. So by pushing through this low, we're basically getting further indication that sellers might be weak, and this market might be likely to lead lower. So if we factor everything that we've put together so far, we have softening buyer control coming in quite a while ago, actually, in June 2025. We've then really ranged and not managed to push significantly higher for almost a year. And then when we did manage to get higher, it was immediately reversed by sellers, with a massive wave of selling pressure completely dominating the buying moves, absorbing the buys and driving back lower. This then led into a break of an internal low, which again just indicates to us that sellers now are stronger than they were previously and buyers now are weaker than they were previously. So we're getting a good idea that sellers are likely in control of this market. Now, with that in mind, we can take a look at the daily and start to assess exactly what's going on from a daily perspective, okay? So what we can see immediately is that huge bullish impulse that we had has been taken out, and this is what that wick was on the weekly time frame. We see a big rejection, which is driving the market back down and again pushing us through this low. Now, an interesting point is that we haven't closed through the low yet, which could say that maybe we end up rejecting and going higher. So that's definitely something we can keep in mind. Now, in order for that case to take place, we would realistically need to see a high break. And that for me would be this high, because this current downtrend that's taking place on the 4-hour, or the daily, is being capped by the high. Now, in markets, when lows break, that indicates seller control. And when highs are maintained, that indicates, again, another level of seller control, because buyers are not strong enough to get through previous highs, right? Means basically there are more people trying to sell assets and willing to sell assets at these prices than there are people willing to buy at higher prices. If we saw the high break, that would tell us that buyers are actually starting to get interest in buying this asset, even for higher prices. So therefore, we could shift into possibility of buys. But as it stands right now, the sellers are maintaining the strength and the buyers are maintaining weakness. So we would say the market remains bearish, providing it stays underneath this high. Now, another important thing to assess is these wicks, because as we know, wicks do indicate rejections, which shows there is at least some buying pressure coming in from these lows. We have to then ask, where is this coming from? If we take a look over to the left, we can see that there is a demand zone down here. Now, what is a demand zone? It's basically a range before an impulsive move, okay? A buying move for the case of demand. Supply is the opposite, so it's before an impulsive downward move. And what supply and demand shows is, in the case of a demand zone, an area that buyers were willing to buy the asset, or a price level that buyers were willing to pay for an asset previously. Therefore, we know this is seen as a discount price. Buyers then, if this level is met, will likely want to take another stab at buying this market, okay? So that's what a demand zone is all about. Supply zone is basically the opposite. If we look at this zone here, it's consolidation before a downward move. Generally, supply zones is sellers were happy to sell here before, happy enough for this to actually break structure, which tells us that this is seen as a premium price for sellers. They like this zone to sell from because, again, you're getting a good price if you're selling your contracts, and you are getting a good entry if you're short selling for a profit on a decline. So that's a premium price. So we could expect that if we get into that range again, sellers therefore will be interested in selling down. So it's all just about identifying where previous significant buying and selling took place from, and then using that as an understanding that this is probably a point of interest. If we get there again, we're pretty likely to start seeing the same things happening, okay? If buyers were happy at that price before, they probably will be again. If sellers are happy at this price before, they probably will be again, right? So anyway, how that actually has relevance here is these wicks, these rejections we see, yes, it is some buying pressure. No, it is not enough to start buying, because we would need to see a high break and then a low maintain to actually validate buying, right? So buying would come in on a pattern like this. At the moment, it remains bearish. And although the buying pressure is coming in, it's actually not really coming in from anywhere significant. It's coming in from what we call an imbalance. Now, an imbalance is basically the gap between a demand zone and then wherever the next kind of point was, or where price is now. So this area that I've just marked here, this open price range, this is an imbalance. And the way that I see imbalance is basically, it's an area where no significant buying or selling is likely to take place, because the premium and discount price levels are above and below these imbalance points, right? So what I see imbalances as basically a magnet for price to draw through and completely fill before retesting a demand or supply zone. And that is where the real solid trades come in from. So what we can expect at this point, basically, is for that imbalance to be filled, because we know that buyers will come in force at some point. Well, if they do, it's likely going to be from a discounted price level or a demand zone. So we could say this is reasonably likely, providing and considering that we maintain this downward trend where we maintain highs and break lows, okay? So we have from the weekly the idea of potential seller domination reversal, big weekly rejection, big drive lower, sellers are currently in control of this market. From the daily, we see a continuation of that in a tighter format where we see the lows breaking and highs maintaining, which again gives us an idea that sellers are in control of this market, and providing we stay under this high, we should look to sell. We see the buying pressure rejections, which is some cause for concern for the sell bias, but when we line up where that's coming from, imbalance, it's really not a significant point that's likely to attract too much attention for buyers. What's more likely is we will at least get to a discount price level. So if we get down into there, then we can worry about the market potentially reversing. But until then, we should realistically remain on the sell side. Okay. So what we're doing is we're reading that story endlessly and just working out who is currently in control of the market. Okay, so dropping to the 4 hour. 4 hour and below is generally where I start to find opportunities. And as I've explained, we can do this on the weekly, we can do this on the 4 hour, we can do this on the 5 minute. The narratives, because they are following the real story of price, they work everywhere. Okay, it doesn't matter if you're on the 1 minute, it doesn't matter if you're on the hourly. These setups all work in the same way, because the way we're reading the market is just reading into them basically the psychology of buyers and sellers and the patterns, the phases they go through, right? So what I'm going to do on the 4 hour, first thing I want to do is, of course, we have our marked in high. We know the market's not likely to get past that. And if it does, that would open up one of our if this, then that alternative opportunities. We would say if the market gets over this high, then it's probably bullish because we're seeing a pushback from buyers, so we can buy. Okay, so that's the if this, then that alternative buy situation. But unless that happens, our focus is going to be on selling this market down towards this area of demand. So that would be basically the basis for the primary trade that I would look for. And what we have here is a selection of things. Number one, the supply zone. We know this was seen as a premium price to sell this price at before. Therefore, it's likely to be seen as a premium price again. Number two, imbalance. Again, this one has a gap. This gap is likely to be filled. That will draw us into the area of supply. And then basically the supply zone being the premium could be the point where we start to see a shift from the sellers regaining control over this short-term bullish move and drive us back down towards the low. So we have here maintain downward price action, a premium price zone that's likely to be a good catalyst for sellers. And then we have our downward targets basically pushing us into this low. So targets wise, we can look at this low here. And we can look at the demand zone beneath, as that's going to be kind of the next magnet point for price. Now we can also see the market is pushing through one of these internal range highs. This is what we classify as liquidity. So this is kind of a key point where basically anyone who's sold from this level below, trading with, standard rules, is going to have a stop loss somewhere in this range, or a lot of those people are. The stop losses for sell trades are buy trades, because if you think about what it is, if you are in a short position, and you have a stop loss on, you basically have sold the contracts. And if your stop loss is hit, you're buying them back for more than you sold them for, which means you take a loss, right? So it means there's loads of buy orders in here. Now, buy orders can actually be really good catalyst for sell positions at certain points, because if we see an influx of selling coming in at the point where there is a massive quantity of buy orders being hit at the same time, we can see basically a lot of selling taking place because someone can take the other side of all those buy trades. That's what we call absorption, where all of the buying orders are immediately absorbed by selling. If we factor how that is currently lining up, we have this potential absorption point where all the liquidity is. We have a premium price zone where we know sellers want to sell from. And we have seller control overall with maintained highs and broken lows. So basically we've got a very good case for selling, right? Now we shift that into the if this then that format. And all we're going to do is say if this market trades into supply and then confirms short like this with a shift in structure, then I will sell. That is if this then that scenario number one. Scenario number two from this point would simply be if the market gets over the high here, then that shows a shift in control. Therefore, I will look to confirm and then buy. Okay, so that's the alternate scenario, and every one of my trades has one of these, because as one trade invalidates, a new opportunity generally will validate, right? So if this sell doesn't work and it does drive higher, then that's going to tell us that buyers are stronger than we thought, and maybe there's some room for us to then trade up towards some next points of supply, for example. But as it stands right now, what we would just want to do is look for that opportunity that we just prepped out. So we're looking for the market to come into this range and then give us a change in the overall direction. Okay, so we've seen the market drive up there. Realistically, what we'd want to see now would be the market coming and closing under this low. Okay, here we see rejections, large bearish movement coming in. Then we get closures beneath, which tells us that sellers are now once again taking control over the short term. So highs, okay, highs maintaining, highs being created, lows maintaining, that's buyer control. And then a low being created and failing, that is seller indication or reversal indication. Now what we would look for is simply the best point to actually sell from, which again is going to be a supply zone. Why? Because this is a premium price zone that has created an impulsive move before. It's likely then that if the market gets into there, we're going to see new sellers see this as a premium price to sell from. So our trade becomes this, and then all we have to do is place an order like that, put our stop over the high, targets down into the low, and then you've got a narrative-based trade. And we've built this out of basically assessing who's in control of the market at this point, which way that leads, and then what the entry criteria would need to be in order to formulate a trade. So what we do is we build the idea, and then we just let the market come to us with the opportunity, right? We're not forcing anything. We're just saying, this is the most likely thing to happen next. Therefore, if this does happen, I will take this position. And as you can see, it results in some pretty high accuracy trades. So that's basically the full flow. That's how this narrative trading works. Build out a full reading of the market, the battle between buyers and sellers, the volume of buying, the volume of selling, and which direction points of interest that is likely leading the market into, and then just set up your entry criteria. If this happens, it's telling me that I should sell. If this happens, it's telling me I should buy, and then just do nothing until one of those two things happens, and then you get A+ positions like this. So that is the flow of narrative-based trading in a systematic way. All right, so now let's bring this all together. What we're doing is we're taking an understanding of the market and we are shifting that into a system that you can run every day. The process goes as follows. First, you want to build out your narrative. This is the top-down flow that we've covered, creating clear answers to who's in control, what confirms that direction, and what would change it. This is the foundation to the opportunities that you are going to trade. Then we move on to trade execution. Form trades and execute them from your narratives by preparing all of the outcomes in advance, setting up the bullish and bearish trade criteria, and then executing from predefined conditions. Shifting your trading from what should I do into which outcome is playing out. Then, of course, we want to systemize it. So we follow the same flow, same concepts, same logic every time. We build the top-down narrative, develop a clear bias, build out the alternative scenarios, so if the market goes against us, we can still find positions, and then define our execution criteria in advance so that we can just trade in that plain, simple, if this, then that format. Every trade that you take in this system is a result of a process that you've already followed. And the real magic behind this approach, of course, is that it is not tied to a specific market, it's not tied to a specific time frame, and it's not tied to any specific schedule. Because your trades are formed by reading the markets deeper and clearer than you've ever seen them before, you can do this on any time frame. The same behaviors, same speculation, the same battles, they're all taking place everywhere. Doesn't matter if you want to trade Euro USD, gold, oil, Meta, or Bitcoin. On the 1 minute, 15 minute, hourly, 4 hour, or daily, as a scalper, a day trader, a swing trader, or a position trader, it really doesn't matter. Because what we're doing is reading basically the market psychology, the buying, the selling, who is in control, what they're thinking at each different point, and how that leads into different opportunities. This is basically translatable to any asset, any time frame, because it's the real dynamic or mechanics of how the market actually moves and what it is that drives price appreciation and depreciation. So this means this system is not someone else's signals, it's not built around someone else's schedule, and it's not someone else's way of trading. It is just reading the real market drivers and then taking your trades around that on whatever preferences you want. So you can day trade it, you can swing trade it, you can trade what you want. It's very, very freeing while remaining systemized. It allows you to shape your trading around your life instead of shaping your life to fit trading, which realistically, we're all trading for freedom, right? So you don't want to box yourself into a system and a schedule that you don't like and you don't want to follow. That's not very freeing at all. If you're going to do that, you might as well get a job. So in the next episode, I'm going to show you how to take the system I've showed you today and everything we've discussed over these past 2 classes and show you how you can build consistency so you can get funded if that's your goal, or just scale your personal accounts and actually make money from trading instead of just wasting all your time, wasting all your money and digging yourself deeper into the hole. The goal is to get you to a point where you can get results like these few just here, because these are real people making real payouts and getting real funded in the same way